The stock market has been moving aggressively higher. Price to earnings ratio, so market valuations, have gone from around 20 back in September of 2022 all the way to 25 today. So a 20% expansion in market valuations in a matter of months. One of the key macro forces that is driving this rally is the big downwards trend in inflation that we've seen since the peak in 2022. Inflation peaks throughout history have been bullish for the market time and time again. Since 1926, we've seen inflation peak above 9% only 6 times, and that's almost systematically been bullish for the stock market, and June 2022 was one of those episodes. Meanwhile, we have a major recessionary signal from the bond market, with the yield curve being inverted to the deepest level since 1983. The yield curve having an incredible track record at anticipating recessions throughout US financial history, and of course predicting big weaknesses in the labor market almost systematically. So between inflation coming down rapidly and the possibility of seeing lots of weakness in the US labor market over the next year, which of these macro forces is going to prevail on this stock market rally? That is going to be the subject of this video. Welcome to Game of Trades. I hope you guys are going to enjoy this video. If you do, don't forget to click on the like button down below and of course subscribe to the channel if you are new here. Now without further ado, let's get right into it. One of the key reasons behind the stock market strength that we've seen over the last few months has been the peak in inflation. If we look at the performance of the S&P 500 following 6 episodes throughout history when inflation peaked at high levels, we see it almost systematically leads to strong stock market performance. The only exception being 1947, with quite weak performance following the inflation peak. And here is how stocks have performed so far since the inflation peak in June of 2022. Stocks have performed quite well, as you would expect after an inflation peak. Now, when we look at stock market performance, there are 2 aspects to consider: the growth of corporate earnings and price to earnings. So essentially the profit that corporations are making and how much investors are willing to pay for a piece of that profit. Now, if we look at typical corporate earnings growth of the S&P 500 following those 6 episodes where inflation peaked at high levels, you can see earnings growth is actually typically quite weak, pretty much staying at 0 or even contracting in the 18 months that follow a peak in inflation. The only exception was 1947 right here, and this time around is actually no exception, with earnings actually contracting since the peak in inflation back in June of 2022. Now, there's actually a reason for this, and that's because earnings growth is calculated nominally, meaning they're not adjusted for inflation. So when you have elevated inflation, it's actually a good thing for earnings, and when inflation is coming down very rapidly, you're going to see earnings struggle. So what actually drives the stock market after a peak in inflation is not earnings, it's price to earnings. It's the actual valuation expansion. In most episodes where inflation peaked at high levels, we saw valuations expand significantly in around the 14 months after the peak in inflation. 1947 was again the only exception where we didn't see PE ratios expand after the inflation peak. You're going to want to remember this date here because we're going to come back to it in just a second. Now, since June of 2022, PE ratios have actually performed as you would expect following an inflation peak, meaning they have expanded quite significantly since the peak. Now, the only problem with this is that the starting point of valuations, the starting point of PE ratios back in June of 2022 was already higher than most of the episodes that we're talking about here. And if you remember, the only exception where we saw poor stock market performance following an inflation peak and where valuations did not expand following an inflation peak was 1947, where PE ratios were at around 12. If you look at valuations in June of 2022, they were at 20, so a very poor starting point for valuation expansion, which is something to consider. Although despite these already elevated valuations, PE ratios have managed to expand by 20%, as we highlighted at the beginning of this video. Now, we've covered the bullish force that has been moving stocks higher, but as we highlighted at the beginning of this video, the potential for a recession is a big tail risk to stocks right now. We've discussed this in prior videos, but the reason that the yield curve anticipates recessions is because when the yield curve is inverted, banks are less likely to lend money, which creates tighter financial conditions for people and businesses. So you can say we are currently experiencing the tightest monetary policy conditions that we've seen since the 1980s. Now, if we look at what PE ratios do after an inversion, and we take a look at 9 episodes since 1962, following the inversion, you can see in most cases, PE ratios fall in the 12 months after the inversion occurs. Now, the only exceptions were actually in 2006 and 1989. In both of these cases, PE ratios eventually reverted back down as the recession played out. So what happened in both of these episodes, 2006 and 1989, is that the recession did not play out straight away. It did not play out in the 12 months after the inversion. So valuations were able to expand. And when the recession actually played out, that's when PE ratios began to fall. And actually today, it seems like PE ratios are expanding in a similar way to 2006 and 1989, as the US economy has not yet entered a recession despite the yield curve inversion, and rapidly falling headline inflation is actually helping PE ratios expand. So if you are worried about a recession because you trust that the yield curve inversion is going to be successful at anticipating a recession once again, but you're wondering why it hasn't come yet, just know that this also happened in 2006 and 1989, and stocks continued to rally in the 12 months after the inversion occurred before the market eventually began to price in the recession. In 1989, it wasn't such a severe recession. In 2006, it was quite severe. Now, as we said earlier, what you also see following a yield curve inversion is a rising unemployment. We haven't seen that yet, but in all episodes throughout history, an inverted yield curve leads to a rising unemployment rate. Now, the reason that is an important point to note is that rising unemployment is historically a headwind for stocks. This is a chart that shows you typical S&P 500 returns before unemployment begins to rise. In the first 1 to 3 months where you see unemployment beginning to rise, 4 to 6 months and 7 to 9 months. The worst returns are actually seen in the first few months where unemployment begins to rise, and that's not something that we've seen yet. So as long as the labor market remains strong and the US economy doesn't fall into a recession, you could continue to see stocks behaving like they did in 2006 and 1989. But when you start to see the labor market crack, if you look at what typically happens throughout history since 1948, the bad news gets priced in very quickly by the stock market. So there are two counter forces that are acting on stocks right now. Inflation coming down rapidly, and that's very bullish for the market from a historical standpoint. And at the same time, we have the potential for a recession that is generally bearish for the market. Then you could definitely say that where we currently stand is where we were in 2006 and 1989, where the yield curve was inverted, but the US economy was not yet in a recession, and the labor market was still relatively strong throughout those periods, which let the stock market rise for quite a significant period of time. If you don't believe that the yield curve is going to be an accurate signal this time around, and that it's not going to be able to forecast a recession, then the combination of the rapidly falling inflation rate that we're seeing, combined with the stable growth and stable labor market conditions that we currently have, could be a powerful bullish cocktail for the market. Of course, you also have to consider that PE ratios are already at 25, which makes the runway for much more upside in valuations limited. So for stocks to continue really rallying, you need to be right about a recession not manifesting over the next year and earnings growth to actually begin turning up as the economy strengthens. I hope you guys enjoyed this video. If you did, don't forget to click on the like button down below. It really helps out the channel. It makes a huge difference. Now, in the meantime, I wish you good luck on your trading and see you next time.